markets. But what is the way forward in this volatile times, in this correction that we are seeing? Let's understand that from Mr. Devender Singhal, who is the EVP and Fund Manager at Kotak Mahindra AMC, joining us on the show right now. Hi Devendra, good to be speaking with you. First up on the markets, Devendra, nothing has been holding up. Since all this while, we have been talking about the broader indices getting into that bear territory. But look at Nifty 50 is down about 15% from those highest points of September 2024. Do you believe that another 5% correction from here on cannot be ruled out? Or you believe that at the index level, we should find some bit of a base building?
So yes, you are right. We have seen around 15% correction in the Nifty. But I think there's not been a single year in the last 30 years where we've not seen something like this happening. But honestly, it looks like that in terms of the valuation comfort, we are very, very near to the bottom or the immediate bottom in terms of where the Nifty or the large caps are concerned. Be it for mid cap or small cap, I think that could be a different story. But in the large cap space, I think the valuations have become very attractive. A couple of percentage points more of correction cannot be ruled out. But I think this is definitely, if you are a serious buyer, long-term buyer, then this is the time to start getting back into the market.
Right, but stick with the large cap, but any sector that you wish to flag off, other than financials, I believe, Devendra, because what we see is that financials as a whole is coming in at the consensus buy. What are your thoughts on that?
Yes, I think worse in terms of the liquidity squeeze and whatever the companies were coming out in terms of the credit cost, it should be over by Q4 or max by Q1. And with the liquidity infusion and the regulation getting eased up a bit, we should start seeing the growth coming back into the market therein. So once the credit growth starts coming back, I think the financials would have a much better shape than they are looking at currently. So yes, definitely that is one space one should be looking at. But I think we are also positive on consumption as a space, though it lacks near-term triggers. But if you see the kind of the uptick which is likely to be happening post the good harvest being there, the dolls which have been given out by the political parties and the central government, and in general the uptick happening, I think we should see a better second half. And then next year we always have the pay commission coming in. So all in all, over the next couple of years, if one has to look at the space, we are pretty constructive on that one.
But the other point to note is that the sell-off that we are witnessing in India is majorly not because, yes, of course, that there are concerns with the earnings growth slowing down. But other than that, a lot of these macro and the global data are weighing heavy on the Indian markets with respect to FIIs taking off the money, what's been happening with the currency front, and of course, the threat related to tariffs. Do you believe that in the near term, the markets should actually try to get away with these signals, or rather try to ignore these signals, or you believe that this time won't be in anytime soon?
See, we are a part of a global market, so whatever happens in one part of the world, we are not untouched by it. Specifically, the disturbances are coming from the US, which is the largest country in the world, largest economy in the world. So, I mean, and we have a lot of dependence directly and indirectly to that. Now, specifically in terms of flows, we have seen flows moving out of the emerging markets into the US. India has been basically on the receiving end of it. So definitely that has impacted. Yes, I think the entire tariff thing should settle down in a couple of months. April is the timeline when Trump is looking at, the entire thing on the reciprocal traffic tariff coming in. And hopefully by that time, India and the US government or the bodies sit together and frame out what could be basically in both the individual interest. Doesn't look like too much of issues with how the way we are positioned, but I mean it is gonna give you a hard volatile time till the time things becomes more clear. Because one thing which market loves, market hates, is basically the uncertainty. Until the time you get these things talked out, I think uncertainty is going to be very high.
But Devendra, the other thing is that though on the index front, we are just talking about a 15 to 20% correction on the number front, but the shades in the portfolio of the investors is even deeper with at least 30 to 40% of the cut. At this point in time, what should be the strategy to deploy fresh money, and how should one look at deploying the money in a staggered fashion? Because when you say that at least it will take a couple of months to get clarity on the tariff decision, so would you suggest to wait by a little?
See, the best time to put money to work is right now, okay? And we've always been saying that. But it all depends on how much you are already invested into the market, what is your risk profile, how much volatility can you basically withstand in the market, and what are your time horizons. So I think if you're underexposed to the market, you should definitely start deploying money now and don't wait for further corrections, or basically stagger it over a couple of next few months at best. If you don't want to do that, then something like a multi-asset allocations or hybrid funds are a good strategy whereby you can take the call now and leave the call on the fund manager to deploy the money at the right time when it comes in. But I think it has to be in conjunction with your wealth advisor. But if you have a long-term horizon, you are underexposed to the market, and you have a risk appetite to be invested for a long term of, let's say, 5 to 10 years, I think this is the best time to put money at work.
All right, but other than that, Devender, talk to us about what's been happening within the IT space, because for today, it's the IT bag that is definitely taking it on the chin. The index is definitely down, but what's the visibility there? Because still now, after the earnings fine print, that was one particular spot where everybody was highlighting that there could be a bit of a margin safety there, but it doesn't seem to be pan out. What are your thoughts?
I think it is safe to say that we have a very large dependence on the US market for IT sector. And the data which came out, basically the jobless claims, that was not in favor of the market, basically showing signs of growth. Coupled with the fear of tariff hike leading to inflation, I think that is what has spooked the markets there. And we are seeing what is happening to IT on that count. I don't think there's anything else which we could put it to. This was one sector which was holding on, but I think this last 10 days it has given up.
Right, but within consumption, Devendra, where to put your bets? Because when I see autos, they are not holding up well, because already after that run-up that we have seen, there are a bit of a valuation and a slowdown concern. When it comes to some of these high PE counters, they are also falling in trade right now. With all those budget announcement as well is now fading away. So within consumption, which are the pockets that you're finding attractive?
So you rightly said that you need to find out pockets where you still find a lot of value and growth coming in, or the expectations of growth are being there. So I think this is not a time when you could basically go and buy a particular sector. It is time to go a bit deeper into all of these sectors, and you need to find out names which can give you better revenue and earnings growth over the next couple of years and up valued attractively for that. So you need to have both the growth and valuation on your side before you can take a plunge. It is not a right time to buy just any name in the market or just go on a particular sector heavy. It is actually time to be really stock specific.
Lastly, Devendra, in this market fall, actually nobody is talking about the PSEs rather. Do you believe that market participants will completely ignore it for some more time?
No, we don't agree with that aspects. See, we have always been telling that whenever you're looking at PSCs, you should look at the business fundamentals. You should look at what kind of revenue and the earning visibility they have over a longer period, and what kind of policy influence can basically change the company's financial performance going forward. If there's too much of a policy initiatives which can take it up or down, then I think you should have a discounted multiple rather than a premium multiple to that. Other than that, if we are finding that on a steady state, any PSCs can give us good returns, good revenue growth and is profitable over the longer term, we are happy to take an exposure there. But as I said, it is really time to be very stock specific now rather than buying a particular theme or a sector.
All right, Devendra, with this, we let you go on that. We really covered a whole host of sectors there, and it was interesting to note your take on the same. Thank you so much.
Thank you.
If you like this video, then like, share and subscribe to ET Now.